Hi, welcome to my channel. My name is David. So you're getting ready for retirement. You're paying down your mortgage, you're contributing to your RRSPs, but there is one gap in your planning that you may not even be aware of that is going to be such a crisis for your retirement. But I'm going to share with you how you can hack your TFSA today to solve that problem. All right, let's get started. Why would you need to hack your TFSA? I know this is going to be a great hack. You're going to love it. But why would you need to hack your TFSA? And the reason is because I kind of share with you a little bit that there is a crisis looming. There's a gap in your planning. I'm going to share with you exactly. But before I do that, I just want to say that this strategy is not right for everybody. Only some people can do this because obviously not everybody's risk tolerance is as high as everyone else. And so some people were like, there's no way I'm going to do that. Forget it. Show me something else. I respect that. But either way, isolated on its own, I'm going to share you this strategy. Just remember, this strategy is on an island. It doesn't know who you are, your risk tolerance. It has no idea what your goals are or your capacity to even do this. So just understand this. Whenever you see strategies on any channel, understand those strategies are on an island. You have to bring those into your own situation, understand how does this work for me? Am I able to do it? And talk to a professional to understand this. But let's have a look at this. I'm going to set this up for you. You are 12 to 15 years away from retirement. You're paying down your mortgage. It's almost paid off. You're paying into your RSPs. You got a good RSP balance, and it's projected to hit that mark that you actually need for income at retirement date. Everything looks good. But here's the thing. You're, let's say, 50 today. You have a look at this chart. This is the retirement zone. This is going to share with you everything in terms of how a timeline works for retirement. So let's say on the left, you're 50 years old. You plan on retiring at age 62. That's that orange arrow that you see there, retirement date. Let's just say you decide at age 62 because that's the age your spouse is going to retire and you want to retire together. 62, you can see here that the earliest age for receiving your CPP benefit is age 60. But you don't want to take it at 60 because you actually want to take it at age 65 because you want a higher monthly payment. So you're going to wait till age 65, get the CPP and old age security. There's a video right here that I can share with you about the optimal age to take your CPP and OAS. So check that out because that's super important. Your latest age to start your RRSP payment, which is called a RRIF, is age 71. So you're choosing, I'm going to push that off as far as I can because you know what, I'll have my CPP, my old age security × 2 because my spouse is here. So that's why I've mentioned the maximum CPP plus OAS at age 65 is $21,829. That's for one person. You multiply that × 2, that's two people, assuming that you are all both going to get your max. And you need to check out to see whether or not ahead of time if you're going to have your maximum. And you can actually do that. I'll put some links below as to where to search for that. You're going to retire at age 62. You're going to start receiving income at age 65. What do you do in that red area, 63, 64, for income? Where does it come from? You don't have any income coming in unless you have some kind of passive income stream coming in, unless you squirreled away some cash under your mattress somewhere. But yeah, I mean, look, you're actually going to need somewhere around 80 to 120,000 depending on what your income. If you're making $100,000 a year, in this video right here, how much money do I need to retire? One of the rules of thumb was 70%. So if you go by that rule of thumb, you need $70,000. Well, that's a lot of money, $70,000 every year. Where is it going to $140,000? You need to have that every single year for those 2 years. Well, that's where your tax-free savings account comes in handy. That's exactly where your tax-free savings account is used in the financial planning cycle of how to receive money. You would dip into some of your non-registered assets, your tax-free savings account, then your RRIF. But you don't have a tax-free savings account, or if you do, you don't have much. This is why you might need to hack your TFSA right now. Let's dig into how to do that. All right, let's get to the hack. Now, this is really important. Remember, this is an idea, a strategy onto itself. It's on an island, doesn't know who you are, doesn't know your situation, has no idea what's going on in your life. So it's just a strategy, so bear that in mind. So let's just look at a normal way of funding it. If you could fund your tax-free savings account $191 bi-weekly for the next 12 years and get 5% rate of return on your money, you would end up with $81,000 in that account. And you would use that money to fund those 2 years that you need in retirement. Why am I choosing that number? Well, it just so happens to be what it would cost you to take a loan for $50,000. Now, what I'm going to suggest right now is the hack. And again, it's not for everybody, but it works. Now, if you were to take at your next renewal date $50,000 onto your mortgage and put it in your tax-free savings account, it's not tax deductible, so don't even get into that conversation. That money, one-time lump sum deposit to your tax-free savings account, don't add anything to it, just pay down the mortgage. It'll grow to $89,000. So remember, $81,000, now you have $89,000. You say, big deal, $9,000 or $8,000. But it's significant. It's the difference of having money in right away as opposed to, putting it in piece by piece over time. Same rate of return, nothing different other than the fact that you get the money in right away. That's time value of money. That's all this is, and it works. Now, why does this hack work exceptionally well? This is what I want to sort of really focus on. How is it that you are able to pay your debt down so well over time? You've been really attacking that mortgage, right? Every single month you make your mortgage payment, whether it's bi-weekly, doesn't matter. You're paying your mortgage every single time, and over time, the balances come down, the home equity goes up. Debt, when it's paid on a systematic basis, when it's done on an automatic basis, things happen, magic happen, right? So I would say to you this, the best way to ensure that you're going to have this money in the end is to take it out of your hands, to not make it a choice, and use your mortgage to fund that gap and just pay your mortgage like you've been doing for how many years now. And that'll get you to a point. So the question would be, is 50,000 the number? Is it less? Is it a little bit more? This is all about your budget. This is all about your goal and how much money you're going to need in retirement. Remember, you can only have $75,500 in deposit in 2021 in your tax-free savings account. You say, well, what about my house? Is my house going to continue to go up? Well, in GTA, home values have gone year over year, up 16%. That's just from this year. Home values have been going up crazy, as you well know, in the GTA. Here's a graph actually of that chart going back all the way to year 2000. Look at the home values. So I want to give you some confidence about using the equity. Your home is going to go up in value, but the thing is you're not going to retire. If we go back to this slide here about the retirement zone, if you're going to retire and stay in your home, you can't eat your home. You're not going to do a reverse mortgage, because you've got money coming with your RRIF payment, with your old age security and your CPP. So you're not going to do a reverse mortgage. You just need to fill this 2 years of gap, and that's the purpose of a tax-free savings account. Some people write it off and say, oh, what's the point? This is the point. It's going to save your retirement. It's so important for you to see that. This goes back to financial planning 100%. The reason why you're in that position is because of the lack of thorough financial planning. It's easy to get that solved. I just shared with you one way. There's a dozen different ways to solve this. And that's why I want you to examine your own personal situation to make sure this is right for you. Thanks again for watching. If you love this video and the content I produced today in this video, please subscribe to the channel, like and share this, because it helps the algorithm to push this video to everybody else that needs to see it. Thanks again for watching. We'll see you in the next video.